What is Forex and how it differs from other markets?
That's such a staggering number to process. To put it in perspective, that's nearly 14 times larger than the daily volume of the entire US stock market.
And what's fascinating is how this enormous market operates completely differently from what most people imagine. Unlike the stock market, there's no central location. It's all happening simultaneously around the world, 24 hours a day.
Let me jump in here because that decentralized nature creates some unique opportunities. You're not restricted to specific trading hours, like with stocks, right?
Exactly right. And here's something that surprises most people. While we think of Forex as this sophisticated financial instrument, everyone interacts with it daily. Every time you use a credit card abroad or check vacation exchange rates, you're participating in the Forex market.
That reminds me, could you break down how currency pairs actually work? I think that's something many people find confusing.
So let's use the most traded pair as an example, the EURUSD. When you see it quoted at 1.12, it simply means 1 euro equals $1.12. Every time that number goes up, the euro is getting stronger against the dollar, and vice versa.
And what's really interesting is how accessible Forex trading has become. How much does someone need to start trading?
You can actually start with as little as $100, which is pretty remarkable. But here's the kicker. Retail traders like us only make up about 2 to 3% of that massive daily volume. The rest is dominated by banks and large institutions.
That institutional dominance must affect how the market behaves, doesn't it?
It does, but often in ways that benefit smaller traders. Because of the huge volume, it's much harder for any single player to manipulate prices. Even major banks can't easily move the market, unlike what we sometimes see with penny stocks.
Speaking of manipulation, I've heard stories about Forex scandals. How does that compare to other markets?
Well, while we've seen headlines about banks being fined for manipulating orders, it's nothing compared to the pump and dump schemes we see in smaller stocks. The sheer size of Forex makes sustained manipulation much more difficult.
That makes sense. And what about the costs involved? I've heard Forex can be more cost-effective than other markets. That's quite different from stock trading fees. And there are fewer restrictions too, aren't there?
Significantly fewer. The stock market has rules like the uptick rule and circuit breakers that can limit trading. Remember during the COVID-19 crash when trading kept getting halted? That doesn't happen in Forex.
Let's talk about the number of trading options. How many currency pairs are we dealing with compared to stocks?
There are about 28 major pairs and crosses in Forex, compared to thousands of listed stocks. But here's why that's actually an advantage. It allows traders to really focus and understand the patterns of specific pairs, rather than getting overwhelmed with endless options.
That focus must help with developing expertise in specific currency pairs.
Exactly. And if you want to trade other markets, many Forex brokers offer CFDs on things like the S&P 500, crude oil, or gold. So you're not really limited, but you can maintain that focused approach.
How has technology shaped the Forex market's evolution?
The decentralized nature has actually driven innovation. We've seen the development of sophisticated trading platforms, automated systems, and AI-powered analysis tools. The Forex market has been at the forefront of many trading technology advances. The accessibility, 24-hour nature, and lower fees are huge advantages. But it's crucial to understand that Forex isn't necessarily easier than other markets. The leverage available can amplify both gains and losses, so proper risk management is essential.
And I imagine the global nature of Forex requires a broader understanding of economic factors?
That's right. You're essentially trading on global economic events, political developments, and market sentiment from around the world. It adds complexity, but also creates more opportunities for informed traders who understand these relationships.
Looking ahead, what trends should people watch in the Forex market?
The increasing influence of digital currencies, the evolution of central bank policies, and the growing role of algorithmic trading are all reshaping the Forex landscape. But the fundamental appeal remains the same. It's the most liquid, accessible market in the world, operating around the clock and affecting every aspect of global finance.
Forex market structure and participants.
Those numbers are truly mind-boggling when you consider the scale. And what's fascinating is how this market brings together such diverse players, from central banks to individual traders.
So you've got these massive commercial banks like Deutsche Bank and JP Morgan at the top of the food chain. They're what we call the interbank market. They're handling enormous transaction volumes and basically setting the prices everyone else uses.
That's interesting. And I've heard there's this whole hidden world of different types of brokers too, right?
Oh man, this is where it gets really fascinating. You've got A book and B book brokers, and most traders don't even know which one they're using. A book brokers are like having a direct pipeline to the market. They use what's called an ECN, or STP system.
Well, that sounds more transparent than the alternative. What exactly do B-book brokers do?
Here's the thing. B-book brokers are essentially taking the other side of your trade. It's like playing poker where the house is your opponent. And you know what's wild? Many traders are using B-book brokers without even realizing it.
That setup sounds like it could create some serious conflicts of interest. So, how can someone figure out which type of broker they're actually using?
Well, here's a clever trick. Try placing trades during major economic news releases. If you get filled immediately with no slippage, you're probably with a B-book broker. A-book brokers typically show more slippage because they're actually sending your orders to the real market. Oh man, central banks are like the puppet masters of the currency world. They're not in it for profit. They're managing entire economies. When the Federal Reserve makes a move, it sends ripples through the whole 6.6 trillion daily market.
And what about major corporations? I imagine they must need to exchange huge amounts of currency. That's fascinating. So, traders could potentially anticipate these moves?
Well, yes and no. The smart money definitely watches these patterns. But here's what's interesting. The Forex market is so massive that even these huge corporate transactions might barely make a ripple unless they're concentrated at specific times.
You mentioned something earlier about carry trades. Could you explain that concept?
Picture this. You borrow money in Japanese yen where interest rates are super low, like 0.1%, then invest that money in Australian dollars, earning 2%. The profit is in the interest rate differential. But here's the catch. If exchange rates move against you, you could lose way more than you make on the interest.
That sounds like quite a sophisticated strategy. Not something for casual traders, I'm guessing.
Definitely not. It's mainly used by hedge funds and large institutions that can handle the risks. And speaking of risks, here's something wild about the Forex market. Unlike stock exchanges, there's no central marketplace. It's completely decentralized.
Though that must create some challenges when it comes to transparency, wouldn't you say?
You know what's interesting about that? While we can't see market depth like in stocks, this decentralized nature means the market is incredibly resilient. Remember when the New York Stock Exchange had to shut down for technical issues? That literally can't happen in Forex.
How has technology changed the game for retail traders?
It's been a complete revolution. 20 years ago, you needed millions in direct bank relationships to trade Forex. Now anyone with a smartphone and a few $100 can access the same market as central banks. But here's the thing. That accessibility is both a blessing and a curse.
What do you mean by that? That's such a vivid way to put it. What should new traders focus on first?
Understanding market structure is absolutely crucial. Know who the major players are, what motivates them, and how their actions might affect currency movements. And here's something most people overlook. Start by really understanding your broker's business model.
This has really opened my eyes to how complex and interconnected the Forex market is.
What is traded in Forex? Currencies and correlations.
You know what blows my mind? The US dollar is involved in over 80% of the $6.6 trillion traded daily in the Forex market, making it the most powerful financial force on the planet.
That's such a staggering number. How do traders even begin to navigate such massive flows of money?
Well, it's actually quite fascinating how organized it all is. Think of the Forex market like this massive international dance floor where currencies pair up in specific patterns. And just like any dance, there are leads and followers.
Tell me more about how these dance partnerships work in currency terms. Oh, wow. So that's why the order of the letters matters so much in these pairs.
Exactly right. And here's where it gets really interesting. All these pairs are organized into three main categories: majors, minors, and exotics. The majors are like the A-list celebrities of the currency world.
You know, I've always wondered about these categories. What makes a currency pair major?
Well, let me share something fascinating about the majors. They've all got these incredible nicknames with amazing stories behind them. Take GBP/USD, nicknamed Cable. Back in the 1800s, they had this massive submarine cable running across the Atlantic Ocean floor between Britain and America, transmitting exchange rates. The nickname stuck for nearly 2 centuries.
That's such a cool historical detail. What about the other nicknames?
Oh, you're going to love these. USD is called fiber because euro notes are made from pure cotton fiber. Then we've got Aussie for AUD, Kiwi for NZD/USD, and my personal favorite, Loonie for USD CAD, named after the loon bird on the Canadian dollar coin.
These names make it sound almost playful, but I imagine there's serious business behind all this.
You're absolutely right. Take the Canadian dollar, for instance. It's fascinating how it's tightly correlated with oil prices because Canada is such a major oil producer. When oil prices go up, the Canadian dollar typically strengthens against other currencies.
So these currencies are connected to real world commodities and events?
Precisely. And here's something that might surprise you. The Australian dollar has a similar relationship with gold prices, since Australia is one of the world's largest gold producers. But it gets even more interesting when we look at how currencies relate to each other.
How so? Are there patterns in how they move together?
Well, imagine you're betting on both USD and GBP/USD going up. You might think you're diversifying, but here's the catch. You're essentially making the same bet twice that the US dollar will weaken. If you're wrong, you'll take double the hit.
That sounds like a potential trap for new traders. What other correlations should people watch out for?
Here's an interesting one. Both gold and the Japanese yen tend to strengthen during times of global uncertainty. They're both considered safe havens, which is why we often see them move in tandem. But, and this is crucial, gold typically has a negative correlation with the US dollar.
Let me see if I understand this correctly. When people lose faith in the dollar, they often turn to gold?
Exactly. And this brings us to something really important about the minor pairs, or crosses as they're called. These are currencies traded against each other without the US dollar involved, like EUR GBP or AUD JPY. They're perfect for traders who want to avoid direct exposure to the dollar.
That makes so much sense. What about these exotic pairs I keep hearing about?
Now we're venturing into the more adventurous territory. Exotic pairs include currencies from emerging markets. Think Polish zloty, Hungarian forint, or Swedish crown. They're like the indie films of the currency world. Less liquid, but potentially very rewarding if you know what you're doing.
You know what I find fascinating? How all of this affects everyday life without most people realizing it.
That's such a great point. When you buy imported goods, travel abroad, or even invest in international stocks, you're actually participating in this massive currency dance. The Forex market impacts everything from the price of your morning coffee to the cost of your vacation.
Speaking of impact, how do these currency relationships affect long term trading strategies?
Here's something crucial that many new traders overlook. These relationships aren't static. They evolve with changing global economic conditions. For instance, the rise of cryptocurrency has started to influence how traditional currency pairs behave, adding another layer of complexity to the market.
That's really interesting. It's like the whole system is constantly adapting.
And that's exactly why understanding these fundamentals is so important. Whether you're trading fiber, cable, or the ninja, you need to grasp not just the technical aspects, but also the broader economic forces at play.
So, what would you say is the key takeaway for someone just starting to explore Forex trading?
I'd say start with the majors. They're more liquid and better understood. But more importantly, always remember that currencies tell stories about countries, economies, and global relationships. It's not just about charts and numbers. It's about understanding the narrative behind the movements.
That's such a powerful way to think about it. These aren't just abstract numbers, they're really stories about our interconnected world.
Exactly right. And as we wrap up, remember this. Successful currency trading isn't just about knowing which pairs to trade, it's about understanding how everything connects. It's like conducting an orchestra where every instrument affects the others and the music never stops playing.
Forex trading hours and sessions.
That's such a mind blowing number. And what's even more fascinating is how this trading follows the sun around the globe like a perfectly orchestrated dance.
Well, let me break down how this incredible cycle works. It all kicks off on Sunday at 9 p.m. GMT, when Sydney opens, then Tokyo joins 2 hours later, creating what we call the Asian session.
So, if we're thinking about the Asian session, what makes it unique compared to other trading times?
Here's what's fascinating. While it has the lowest volume of the three sessions, the Asian hours are dominated by the Japanese yen, which makes up about 20% of all global Forex transactions. You've got this interesting mix of players from Japan, Singapore, Australia, and New Zealand, all influencing the market. Exactly right. And speaking of personalities, when London opens at 8 a.m. GMT, it's like the whole market shifts into a higher gear. London alone accounts for over 30% of all Forex trading volume, which is just staggering when you think about it. Oh, you better believe it. The European session is when pairs like EUR GBP and GBP JPY really come alive. But here's what's really interesting. There's this distinct pattern where markets surge at the London Open, then calm down during lunch hours, only to pick up again when New York joins the party.
That reminds me, the overlap between London and New York must create some unique opportunities, right?
Exactly. That overlap period from 12 p.m. to 4 p.m. GMT is like the Super Bowl of Forex trading. You've got the US dollar, which is involved in over 80% of all trades, meeting the European majors head on. The volume during these hours is absolutely massive.
Well, that explains why so many traders focus on those specific hours. But what about the weekly patterns? I've heard different days have different characteristics.
Let me tell you something fascinating about that. Mondays typically start slow, but by Tuesday, the volatility doubles. Wednesday and Thursday are usually the most active, while Friday's interesting because even though overall volume is lower, you get these massive moves during key economic releases.
That's really helpful for planning when to be in the market. How do professional traders typically approach these different sessions?
You know what's interesting about that? Most successful traders don't try to trade everything. They specialize in specific sessions that match their strategy and lifestyle. Some focus exclusively on the London Open, others on the New York session, and some even prefer the quieter Asian hours.
That makes so much sense. It's about finding your sweet spot in this 24-hour cycle.
And here's something crucial to understand about these markets. While Forex trades 24/5, other markets like indices and commodities have their own rhythms. Take the US indices, for example. They trade 23 hours, but have this thing called the pit session, starting at 2:30 p.m. GMT when volume really picks up.
The way all these markets interconnect is fascinating. How has technology changed the way these sessions work?
That's such an important point. While electronic trading has made everything faster and more accessible, the fundamental patterns haven't changed much. The session overlaps are still crucial. Economic releases still drive major moves, and human psychology still plays a huge role. Precisely. And that's what makes this market so incredibly fascinating. It's this perfect blend of high-tech trading systems and human decision-making, all playing out across different time zones. The key is understanding both the technical aspects and the human elements that drive these markets.
That really puts things in perspective. It's not just about charts and numbers, but about understanding this global ecosystem.
And that's really the heart of it. Success in these markets isn't about trying to catch every move in every session. It's about understanding these complex patterns and finding where you fit best within this global trading rhythm. Whether you're an early bird catching the Asian session or a night owl trading New York, there's a place for everyone. You just need to find your rhythm.
Technical, fundamental, sentiment, and statistical analysis. Which one is best?
Trading analysis is like trying to solve a complex puzzle while the pieces keep changing shape. Most people think they just need one approach, but today we're going to reveal why that's a dangerous oversimplification.
That's fascinating because I've noticed how traders often limit themselves to just one method, usually technical analysis, when there's this whole world of different approaches out there.
Let me break this down. We've got four major types of analysis: technical, fundamental, sentimental, and statistical. Each one gives us a unique lens to view the markets through, kind of like having different specialized tools in your toolkit.
So, what makes technical analysis the most popular starting point for most traders?
Well, technical analysis is appealing because it's all right there on the chart: patterns, indicators, and price movements that traders can visually interpret. The fascinating thing is that about 80% of day traders start with this approach.
That's quite a high percentage. How do these technical traders actually make their decisions?
Here's where it gets interesting. They typically split into two camps. You've got the indicator traders who rely on things like the RSI, which measures momentum on a scale of 0 to 100. And then you've got the pure price action traders who focus solely on raw price movements and patterns. That's exactly the challenge. Two traders can look at the same chart and come to completely opposite conclusions. For example, when the RSI hits 70, one trader might see an overbought signal and sell, while another might see strong momentum and buy more.
So, how does fundamental analysis differ from this approach?
Think of fundamental analysis like being an economic detective. Instead of charts, you're analyzing things like GDP growth rates, inflation numbers, and central bank decisions. Did you know that major currency moves can often be traced back to interest rate differentials between countries?
That sounds incredibly complex. How do traders manage to keep track of all these economic factors?
They use what we call a macro calendar, which schedules all major economic releases. But here's the kicker. Even with perfect timing, fundamental traders still face a major challenge. The market doesn't always react logically to news.
Tell me more about sentimental analysis. It seems less commonly discussed than the others.
Well, sentimental analysis is like having X-ray vision into what the big players are doing. The weekly COT reports show us positions of major institutions, which control about 70 to 90% of futures market volume. Think of it as following the smart money.
That's quite a significant portion of the market. How reliable are these institutional positions as indicators?
Here's the fascinating part. Even the biggest institutions can be wrong. In fact, historical data shows that when institutional positioning gets extremely crowded in one direction, it often signals a potential reversal.
So, what role does statistical analysis play in all of this?
Statistical analysis is like having a trading time machine. It uses historical data to calculate probabilities of certain market behaviors. For instance, if a currency pair has bounced off a particular price level 80% of the time in the past 5 years, that's valuable information.
But markets are always changing. How do traders adapt their statistical models?
That's where the real skill comes in. Professional traders constantly update their models and combine all four types of analysis. Think of it like a doctor using multiple tests to make a diagnosis. You wouldn't want them to rely on just one reading.
How do traders weigh these different analytical methods when they conflict with each other? What's the most common mistake you see traders make with these different methods?
The biggest mistake is treating these methods as competing rather than complementary tools. It's like trying to build a house with just a hammer when you really need the whole toolbox. Each type of analysis fills in gaps that the others might miss.
So, what's the key takeaway for someone trying to improve their trading approach?
Start by mastering one method, but don't stop there. Gradually incorporate the others. And most importantly, understand how they work together. Remember, the markets are constantly evolving, so your analysis needs to evolve too.
That really puts things in perspective. It's not about finding the perfect method, but about building a comprehensive analytical framework.
Exactly. And that's what separates successful traders from the rest. They're not just looking at charts or economic data in isolation. They're piecing together a complete market picture using all the tools at their disposal.
Margin trading.
Trading with margin is like having access to a Formula One car when you've only driven sedans. It can take you to incredible speeds, but one wrong move could end in disaster. Today, we're exploring how a simple trading tool has caused more account blowups than any other factor in Forex.
That's such a powerful analogy, and it reminds me of the shocking statistic that over 80% of margin traders lose their entire accounts within the first year of trading.
Well, let's break down why that happens. You see, margin trading allows you to control $100,000 worth of currency with just $2,000 in your account. It's like putting a tiny down payment on a massive purchase. Think of it this way. If you're trading one standard lot of EOR USD, which is $100,000, you only need to put up $2,000 as collateral. That $2,000 gets locked away like money in escrow until you close the position.
That's exactly where many traders get into trouble. They see the potential for huge gains without considering the downside risk.
Right? And here's what's fascinating. That same leverage that can turn $2,000 into control of $100,000 can also amplify your losses just as dramatically. I've seen traders lose their entire accounts in minutes during major market events.
Speaking of market events, what happened during Brexit was a perfect example of how margin trading can go wrong, wasn't it?
Oh man, Brexit was like a perfect storm. Traders who were using high leverage saw their stop losses get blown through due to massive slippage. Some positions were filled hundreds of pips away from their intended exit points.
That brings up something crucial about account balance versus equity. You know, I think this is where many traders get confused.
Let me paint a clear picture. If you deposit $10,000, that's your balance. But let's say you open several trades that are currently showing $2,000 in profit. Your equity would be $12,000, even though your balance is still $10,000.
And that floating profit isn't real until you actually close the positions, right?
Exactly. It's like having unrealized gains in the stock market. Until you sell, it's all just numbers on a screen. And this brings us to something critical: margin calls and stop-out levels.
Now that's where things get really interesting. Could you explain the difference between these two? I think there's a lot of confusion about this.
Well, a margin call is like your broker sending you a warning flare. Hey, your account is getting dangerously low on funds. But the stop-out level, that's the point of no return. When you hit that level, usually around 70% of your margin level, your broker starts automatically closing your losing positions.
You know what's fascinating about that? Many brokers report that over 60% of margin calls end up reaching the stop-out level.
That's because traders often freeze when they get that margin call notification. Instead of making a decision, they hope the market will turn around. It's like watching a car crash in slow motion.
That reminds me of the overnight holding costs, the swaps. How do these affect margin traders?
Swaps are the silent killer of trading accounts. When you hold positions overnight, you're either paid or charged interest based on the interest rate differential between the currencies. Some traders ignore these costs until they've eaten away a significant portion of their profits.
So what's the solution? How can traders use margin responsibly?
The key is multi-layered risk management. First, never risk more than 1 to 2% of your account on any single trade. Second, maintain a healthy margin buffer. I recommend keeping at least 50% of your account as free margin.
That's interesting. So it's not just about having stop losses in place?
No, it's about having multiple layers of protection. Think of it like a medieval castle. You need a moat, walls, and guards. In trading terms, that means position sizing, stop losses, and proper margin management.
Well, that brings up an important point about market conditions and volatility.
During high volatility periods, you should actually reduce your position sizes and increase your margin buffer. It's like driving. You slow down when the roads are wet. I've seen too many traders maintain the same position sizes during major news events, only to get wiped out.
Those are some really valuable insights for anyone considering margin trading.
Remember this: margin trading is a tool, not a shortcut to wealth. Use it responsibly understand its mechanics, and always maintain proper risk management. The goal isn't to make a fortune overnight. It's about consistent, sustainable trading that lets you live to trade another day.